On the day you and I are doing the big picture, the IEA recommended that its member governments release 60 million barrels of oil a day for the next 60 days. So they're going to release 2 million barrels a day. And it's basically to make up for the oil that we've lost from, let's say, Libyan exports coming offline, because we lost a little over 1 million barrels a day, plus the needed oil that we need to expand economic growth. Because higher oil markets, triple-digit oil prices have had a negative effect on people's pocketbooks, on companies' profit margins. So they intervened. And first they intervened by changing margin requirements. And everybody remembers when they raised margin requirements for silver, but they also raised margin requirements for oil. They raised margin requirements for the agriculture sector. At the same time, they lowered margin requirements for, let's say, stocks and bonds. So this gets back to what I call the good inflation and the bad inflation. And the way the government looks at it is if stocks and bonds go up in price, that's the good kind of inflation or good kind of asset appreciation. On the other hand, if oil prices go up, the price of wheat or corn or precious metals go up, that's the bad kind of inflation. So here we have the government intervening through regulation, through margin requirements, and now releasing strategic petroleum reserves. And the thing I want to point out here is those strategic petroleum reserves were put in place as a result of the oil embargo of the 70s. They were to be used for massive disruptions, either geopolitical or weather. And we've only used them twice before. Once, we used them during the first Gulf War, and then secondly, right after Katrina and Rita, when we lost about 40% of our production in refinery capacity after those two major hurricanes. To release oil right now for this is really stupid. I mean, what you're doing is you're taking your emergency supplies in trying to short-term manipulate the price of energy. The other thing that we have is we have the government, through the Fed, intervening in the financial markets by keeping interest rates artificially low. On the day you and I are speaking, John, and this is something that I think most people will find shocking, the yield on a 3-month Treasury bill, you might as well call it zero. It's 1/100th%. A 6-month T-bill is 7/100th%. And this gets back to what I call financial repression, where you keep interest rates artificially low, and at the same time you run a higher rate of inflation. And then the other thing that gets back to the idea that we don't operate in free markets, we had the government intervening with TARP, TELF, all these various, the stimulus program. We bailed out the banks, we bailed out insurance companies, we bailed out the investment banks like Goldman Sachs, we bailed out the unions, we bailed out government workers, and at the same time we're trying to support the price of housing. And housing prices rose at almost double-digit rates during the last decade to a level that was really unsustainable. And what the government is trying to do is make unrealistic prices sustainable through various mechanisms of supporting it, rather than allow the markets to function where market prices fall to a level that you now make it affordable for new home buyers or investors to come in. But you're right, John, we don't operate under free markets.
Well, if we take the stipulation that we don't operate as a free market, and let's face it, since 2008 when everything really did fall apart, the world is a lot different in the financial arena, and the economy is not recovering, because I remember you would talk about this a couple of years ago, how the rules had all changed and people were still trying to operate under the old rules. Well, the new rules are in function, or people were trying to figure out what they are. But if you're an investor, this would also mean that you're going to have to employ some kind of different strategy in this kind of an environment, because trying to use strategies that worked under the old rule set isn't going to work. You're going to get hurt.
No, I mean, you're going to see more volatility. You're going to see interest rates. It used to be, John, when, let's say, inflation start to rise, what would happen? The Fed would begin to raise interest rates to slow down the economy. The economy would go into a recession. And when it went into a recession, stock prices would fall. Well, if you were an investor, you simply tactically moved over into the bond market. Yields eventually fell. You made money holding bonds. And then eventually the economy would go through a recession. The Fed would then begin to counter by lowering interest rates to re-stimulate the economy. Your bonds would appreciate. You'd switch from stocks to bonds. Well, if you take a look at it right now, you're going to have to be a lot more nimble as an investor because those rules aren't applying. I mean, the Fed has lowered interest rates to virtually zero, and we're still talking about a rising unemployment rate that could be heading back up to 10%. So, I mean, one of the ways that we have had to adapt is we have what we call our core portfolio, and that is centered around two key themes in the marketplace. One is the debasement of the dollar and devaluation of the dollar, and the second one is peak oil. And the fact that the government is now releasing oil from its strategic petroleum reserves to try to bring the price of oil down just tells you how real peak oil is becoming. If the Saudis really had 4 million barrels of spare capacity, why haven't they been able to increase production since 2005? I mean, the Saudi government needs between $80 and $90 oil just to pay their bills. I mean, the king just gave away, I think, what was it, $90 billion to keep the residents of Saudi Arabia happy so he could maintain his power base. But, I mean, the old rules have been thrown out. And what really caught me this week was Bernanke's press conference. And if you take a look at what's happened in the first quarter, GDP slowed from around a 3% annualized rate in the fourth quarter of last year to 1.8% in the first quarter. And if you look at the second quarter numbers by any measure, whether you're looking at regional Fed surveys, ISM, factory production, it looks like the economic growth rate in the second quarter of this year is going to be much, much lower than the economic growth rate was in the first quarter. And it was amazing because in their forecast, the Fed has now lowered their predictions for economic growth to like 2.5% or 2.2% in that range for all of this year. Well, that means if you're growing at less than 2% in the first quarter, and it's likely that the second quarter will be barely positive, the only way that you're going to grow at 2.5% is if the third and fourth quarter, all of a sudden we have economic growth rates at 3 to 4%. They also lowered their economic targets for next year, and also they raised their targets for unemployment. So the Fed clearly knows the economy is slowing down, yet they're sticking to this mantra for somehow magically inflation is temporary. And number two, the economy is going to pick up and grow and become stronger in the second half. It's like, well, things didn't work out in the first half. Well, we're back to the soft patch, soft landing, second half growth story, which is they always throw. I would suspect, John, by the time we get the GDP numbers for the second quarter, and by the time we get to this year's Jackson Hole speech, Bernanke and company are going to be singing a different tune.
Well, you know, the Fed's been calling all of this temporary. Of course, they've been calling it temporary since 2008. And one of the things that we've observed over these last 3 years has been the widening gulf between pronouncements versus what real world numbers are telling us. For example, we're reading here on the show every week. You do the economic numbers, and they're telling one tale. The mouths of both either the politicos or people from the Fed, etc., are telling a different tale.
I mean, there's no way that these governments can take on more debt at those kind of rates and pay that kind of interest and survive. It simply won't work.
Well, you know, these things don't arrive in a vacuum. The subprime mortgage crisis didn't arrive in a vacuum. I know that because we were talking about it for over 3 years before it happened. But, you know, there were several announcements this week that it's like the little flags going up before a storm coming in. They're letting you know that something else is on the way.
Yeah, I mean, 3 or 4 weeks ago, we had the report coming from the Medicare trustees that basically said Medicare is broke. People dismissed that, and they said, no, those numbers, that's down the road. But this week, it started out with the U.S. Postal Service. They are going to suspend contributions to employee retirement accounts to save $800 billion this year. And normally what they're doing is they're making payments of about $115 million made every other week. So the postal union is broke. And right now, there's about 563,000 postal workers and about 469,000 postal retirees. And if you take a look at the Postal Service, they reported a loss of $8.5 billion last year. Their second quarter loss in this fiscal year was $2.6 billion. So it looks like this year they're on course to lose over $10 billion. So that was coming from the U.S. Postal Service. Now, what nobody saw on Wednesday was the Social Security trustees said that 2010 was a key turning point. The Social Security problem is now $1.2 trillion worse this year than it was a year ago. Social Security owes $9.1 trillion more in benefits than it will receive in taxes. And they talk about what was a key pivotal year was 2010. For the first time in Social Security's history, Social Security paid out more in benefits than it took in taxes. They were down roughly by about $46 billion. And, John, that number gets worse and worse each year. And there's no way you're going to be able to fix this number. That's why when we had Alan Simpson talking about going to means testing, extending the retirement age, none of our politicians want to talk about it, but it's coming. I mean, Medicare's broke, Social Security's and Medicaid is broke, the Postal Service is broke. You know, we're talking about this debt issue that we're having to deal with, but look what the Treasury's doing. The Treasury is suspending issuance of state and local government securities. They're suspending investments in the government securities fund, the G fund, and the stabilization fund, and the civil service fund, and they're using that to make their payments because of this debt ceiling limit. You know, there's so many headwinds, and if we just want to summarize this, the macro headwinds that the economy's facing right now, there are numerous ones. U.S. housing, still in a double dip. Unemployment rising, state deficits rising, global rate hikes around the globe are going to slow global economies. We've got the euro crisis, the federal debt limits, and we've got inflation. And the experts are trying to say that this is only a soft patch, that it was due to Japan. But in every one of these surveys done in all the ISM, the regional Fed reports, they asked, you know, what's most important, Japan's earthquake or references to Japan as causing problems for your business or inflation? By almost a 6, 7, 10 to 1 margin, it was inflation. And so whatever the experts are telling you, they're not telling you the real story. And the other thing, they're trying to revitalize credit in the private system. It's not working. Consumers are maintaining spending by drawing down their savings, and they have limited access to credit because simply many people are upside down in their mortgages, upside down in their lease payments, their car payments. And so, John, in the end, mark my words, what you're going to see coming out of all of this is sometime this fall, we're going to have a massive both monetary and fiscal stimulus to try to crank this thing up one more time and hopefully to revitalize the economy by the time we get to the election. But it's coming. And look for the Fed to start changing its tune. And by the summer end, I think you could even see almost a zero or negative print for GDP. Same thing with the ISM reports. On the good side, you're going to see a fall in commodity prices, which should translate into a falling CPI and PPI. But in the end, you're going to see a combination of both fiscal and monetary stimulus to the tune of several, probably the combination between them, I would suspect, close to several $1 trillion. And look for next year that the U.S. could experience for the first time a $2 trillion budget deficit.